So far I've spoken to you about, I've explained the benefits of starting a pension, and I've talked through a TTR strategy. I just want to provide a quick recap on the superannuation components. Everyone in this room that does have superannuation will have underlying components. You may have heard of them, the tax-free and the taxable component. Just quickly, the tax-free component will always be tax-free no matter what. This component generally comes from non-concessional or tax-paid contributions to your super fund, and the taxable component generally comes from concessional contributions where a tax deduction has been claimed, and these include your salary sacrifice, like I just explained, or your 9% employer contributions also form part of that taxable component. So that leads us to the next strategy, which is a withdrawal and a recontribution strategy. Now, the objective of this strategy is to increase that tax-free component and decrease the taxable component. So how do we do this? Quite simply, we want to try and withdraw as much as that taxable component out of the super fund, and then we want to put it back in, that same amount back in as a non-concessional contribution, which would then form part of that tax-free component. And you might ask, why do we do this? If you're over 60, I just said that you'll never pay tax ever again. That is right. It does provide a benefit. There's two reasons. Firstly, if you're between 55 and 60 and you want to withdraw your superannuation benefits, it is important to try and reduce that taxable component. And the second point, which might be less front of mind, is from an estate planning point of view. Now, upon death, your beneficiaries are liable to pay 16.5% on that taxable component. So I'm going to talk through this strategy and show you how that can provide a benefit to your beneficiaries. Okay, so we're sticking with Bill. Bill's now turned 64 years of age. He's since retired, and he has a superannuation benefit. He has a super fund worth $1 million. Now, this is all made up of that taxable component. Okay, so what Bill's going to do is going to withdraw $450,000 from super. I'll explain why I've chosen that figure in a moment, and he's going to recontribute that amount as a non-concessional contribution, which will form part of that tax-free component. Now, if Bill were to pass away prior to undertaking this strategy, we're going to have a look at the tax liability that his beneficiaries, such as adult children, may be liable for. Now, as you can see, the taxable component was 100%, so $1 million. Bill would be up, his beneficiaries would be up for $165,000 or 16.5%, which is the tax applicable. Now, by undertaking this strategy, we've reduced Bill's reduced his taxable component from $1 million down to $550,000. So therefore, tax of 16.5% is therefore applicable on that amount. So the tax liability reduces down to $90,000. Now that's a $74,000 one-off saving simply by undertaking this strategy to his beneficiaries. Now just a couple of considerations I want to step you through regarding that strategy. I did pick out $450,000. Now, in case you didn't know, $450,000 is the maximum that you can contribute as a non-concessional contribution under the bring forward rule, where you bring forward an additional 2 years. So that is the maximum. It would be nice to pull out more and put more back in, but unfortunately you're restricted as to how much you can put back in. And just another point, the withdrawals that in this example that Bill did, that you do pull out of your superannuation fund are proportionate according to that tax-free and taxable split. So in my example, it was quite simple because 100% of Bill's superannuation benefits were that taxable component. If, for example, he had a 50% tax-free component, 50% taxable component, the benefit of this strategy would be reduced because he's pulling out some tax-free and putting it back in. So it does somewhat reduce the benefit of the strategy. I now want to talk to you about the next strategy, which involves isolating or separating pension interests. Now, effectively what it is we want to create we isolate pension interests and effectively by creating multiple pensions. And the reason we do this is we want to try and preserve that tax-free component that I just spoke to you about. Once again, going to work through an example to show how we actually go about doing this. We've got Bill again. He's got his self-managed super fund at the top here. Now that $450,000 that we that he pulled out before, rather than put it back in and just lump it together into one pension, Bill's going to start isolate that money into a second pension. Now that is 100% tax-free. The existing pension of $550,000 is still taxable. Nothing changes there. Now the reason we're doing this is to try and, as I mentioned, to preserve that $450,000. So keep as much of that as we can. So as you recall, Bill, his income requirement was $70,000 per year. So what he's going to do here, in terms of his pension payments, he's going to only draw the minimum from that tax-free pension because he want to preserve it. Now his minimum is he's ticked over 65 years of age, so his minimum pension requirement is 5%. Now that works out to be $22,500 a year. Now the maximum, the remainder, which is the majority of his pension payments, which is $47,500, will come from that taxable component. So effectively we're drawing down more on that taxable component. Now in terms of the benefit, we're going to once again look over a longer time frame to see what benefit this does actually provide. Now that taxable component that I talked about prior to undertaking this strategy would be around, for Bill, would be around $480,000. After initiating this strategy, we've managed to increase the tax-free component. So the taxable component would reduce, which is a good thing, down to around $327,000. Now, as you recall, 16.5% tax is payable on that taxable component. So if Bill was to unexpectedly pass away in 10 years' time, that's a $25,000 immediate benefit to his beneficiaries by preserving that tax-free component. Now, if you add that together with from our previous example, with the withdrawal and recontribution strategy, that's around $100,000 that he saved his beneficiaries. The next strategy I want to speak about, it's the last one as well, is it involves your pension payment breakdown. Now this strategy works with a couple when one member of the couple is over 60 years of age and the other member of the couple is under 60. Now, unless a couple share the same birthday or a birthday very close together, this strategy can provide some advantages. Now, so effectively, like the previous strategy, it does reduce that ongoing tax liability via the management of these payments. Now, we're going to have a look at an example to show you how it works. So we've got Bob, who's 62, and we've got his wife, Betty, who's 57. Now, their super fund is worth $1 million. Now, they have interests of $500,000 each. All their benefits are the taxable component, once again, and they have an income requirement of $150,000 a year. So if Bob and Betty weren't to seek any advice and they just, they start a pension themselves, they'd probably be, why not just split that income $75,000 down the middle? Why not? Bob, as I've explained earlier, he's over 60, so he pays no tax whatsoever. Betty, on the other hand, is under 60, so she will be liable for tax at her marginal rate. Now, $75,000 works out to, she'd pay tax of around $17,000 per annum. Now, there is that pension rebate of 15%, which does offset that tax down to around $6,300. However, if Bob and Betty undertake some careful tax planning, they can restructure those payments. So what we want to do is draw the minimum amount from Betty, given she's under 60, and as much as we can for Bob. Now, the reason we've chosen $20,000 for Betty is because that's her minimum pension requirement, which is 4% of her account balance of $500,000. Now, on $20,000, she'd pay minimal. It would result in minimal tax of around $2,400. However, that pension offset of 15% effectively wipes that tax liability away. So, and of course, Bob over 60. No tax is applicable to him. So therefore, this strategy has the ability to save, on an annual basis, around $6,300. So in summary, I hope that you've learned today that there are various strategies out there, some of them not so mainstream, you mightn't have heard of them before, that can significantly add value for those over 55 to your superannuation benefits. Now, each client is different, each scenario is different. A lot of these are complex strategies, so I encourage you to speak to your advisor and talk through these strategies. And obviously, part of our role as your advisor is to meet regularly, provide this advice and assist you not implementing it and maintaining the strategy over time as well.